Today, we're digging into a really fascinating investment analysis on Ather Energy, one of the biggest names in India's booming electric scooter market. So, is this a high-growth superstar or just a cash-burning machine? Well, let's find out. Okay, right off the bat, the analysis we're breaking down gives Ather a final conviction score of 8 out of 10. That's a pretty strong signal, but here's the kicker. How did they land on that number for a company that is, by all traditional metrics, still unprofitable? And here is the central puzzle, right? On one hand, you've got this absolutely staggering 200% return in the last year. I mean, that's the kind of growth investors dream of. But then you look at the other side, and you see this deeply negative price-to-earnings ratio, which basically screams, we're losing money. So, yeah, how on earth do you value a company like this? That's exactly what we're going to unpack. We're going to follow the logic of this investment memo to really understand the thinking behind that high conviction score. All right, so first, a quick primer. Who is Ather? Well, they're a huge player in India's electric two-wheeler space. And what really sets them apart, is their vertical integration. We're talking designing and assembling pretty much everything in-house, the scooters, the batteries, even the software. This gives them this really cool, unique ecosystem, and you can see it's working. Their market share is climbing fast. Oh, and having a giant like Hero MotoCorp as a major backer, yeah, that definitely adds a lot of stability. Okay, now let's get to the real heart of the analysis, balancing the good against the bad. This is where we dive into the financials, the strategy, and see what's really going on under the hood. So, on the plus side, revenue growth isn't just strong, it is accelerating. And check this out, this is the really wild part. The revenue from just one quarter in fiscal year 26 is almost half of the entire revenue from the whole previous year. I mean, that is just explosive growth. And this right here is the other half of the puzzle. Yes, they're still losing money, but look at how dramatically those losses are shrinking. The analysis points out a 57% drop in net loss year over year for the third quarter. What that tells you is that the company is really getting its unit economics in order. It shows they're on a clear path to actually making a profit. Okay, before we go any further, let's quickly nail down a key concept, a moat. Just think of it like a castle's moat. It's a company's protective shield, that special advantage that keeps its competitors away. It's absolutely crucial for any company that wants long-term success. So, the big question is, how strong is Ather's moat? Well, according to this analysis, it's narrow. And here's why. While their in-house design and software ecosystem are huge strengths, you've got to remember the Indian EV market is an absolute battleground. You've got heavy hitters like Ola, TVS, and Bajaj all in the ring. So that intense competition definitely puts a damper on their advantage. All right, now this is always interesting. Let's follow the smart money and see what the big institutions are doing. This chart shows who's been buying and who's been selling Ather's stock. You can see the promoters, they've trimmed their holdings just a tiny bit. And foreign institutions, they've been selling off a decent chunk. But look at that big green slice. Domestic mutual funds are buying in, and they're buying in heavily. So what we have here is this really interesting divergence. You've got foreign investors heading for the exits, while the domestic institutions, the ones who arguably have a much better feel for what's happening on the ground in India, are showing some serious conviction. The analysis suggests that this can often be a sign that a stock is either bottoming out or getting ready for a big run. Okay, so with all that in mind, let's look ahead. The memo smartly breaks down the next 18 months into 3 possible futures. You've got the bull case, the base case, and of course, the bear case. First up, the bull case, the super optimistic scenario. This is where everything just goes perfectly right. We're talking favorable government policies kicking in, their new products becoming massive hits, and their market share just rocketing past 25%. In that world, Ather more than doubles its revenue, and this is the big one. It actually turns a profit. That would easily justify a really high target price. Next, we have the base case, which the analysis gives a 50% chance of happening, making it the most likely outcome. Here, Ather basically just keeps doing what it's doing. Growth is steady, those losses keep getting smaller, but they don't quite hit profitability in this time frame. Still, the progress they're making would warrant a pretty solid target price. And finally, you have the bear case. This is the what if it all goes wrong scenario. The risks we talked about, they become reality. New products are a bust, brutal price wars destroy their margins, and maybe some key government policies change for the worse. In this world, revenue growth stalls, losses actually get bigger, and yeah, the stock price could take a serious hit. This table just lays it all out perfectly, doesn't it? You can see the whole range of outcomes, side by side, from turning a nice profit in the bull case to those losses getting much worse in the bear case. It's pretty clear the analysis is banking on the base and bull scenarios happening, and that's a big reason why that overall conviction score is so high. So, you weigh the incredible growth, the shrinking losses, the tough competition, and these three possible futures. How do you bring it all together to make the final call? Okay, this is one of my favorite parts of the whole analysis. They use something called pattern recognition, comparing Ather today to Eicher Motors, that's the company behind the iconic Royal Enfield motorcycles, back in the early 2010s. Eicher was in a similar spot, completely transforming a market with a premium product, and they went on to become a massive success story. The parallel here suggests that Ather could be on a very similar, very exciting path. But look, every investment has what you could call a kill switch, that one single threat that could derail the entire thing. For Ather, it's pretty clear, a premature end to government EV subsidies. If that government support gets pulled before Ather is profitable and can stand on its own, well, it could seriously cripple demand and change the whole story. And that brings us right to the one-line thesis from the report. It basically argues that the market is way too focused on the past, on the historical losses, and it's completely missing the clear signs of improving economics, and more importantly, the enormous market opportunity that's right in front of them. And so that leaves us with one final big question to chew on. With that path to profitability still a little ways off, is Ather's biggest catalyst its cool technology and its smart business plan, or is it just riding the massive wave of a booming EV market? I think the answer to that question is what will ultimately decide its future.